Hello everyone, George Rivera here with Simple Lending Mortgage. I want to do a video today. If you've seen some of my previous videos, I talked about overlays and how a lot of loans are denied caused by overlays rather than actually not able to do based on the loan program. I did a loan, this actually closed, and this is a loan that I want to show you, and this is a perfect example of loan overlays, lender overlays. And this is one that was actually turned down by four different mortgage companies before it came to me. We were able to do it, and really the reason for the denial of this loan was more caused by this overlay. So it is fair to say this is an actual credit report. I definitely went ahead and I blacked out anything that was personal or anything that should not be shared. And I wanted to be as transparent as possible with this report because I wanted to show you the perfect example of how we were able to do this and why. This was a VA purchase loan that we did in Georgia, and this is the credit scores. You could tell here with the Experian, TransUnion, and Equifax. So when you're doing a mortgage, it is important to understand that the credit score that they use, first of all, is actual FICO. So it is not the scores that you will see on Credit Karma or any of these credit monitoring systems that you have that use different things like the Vantage score and TransVantage and all these different names. That's what we call it, FICO. This is actual FICO scores from the three main bureaus, Equifax, TransUnion, and Experian. When you're doing a mortgage, they're going to use the middle of the three scores. So, for instance, in here you can see the highest score is a 591, the lowest score is a 496, the middle score is a 589. A lot of the times when you have these credit monitoring tools, you get usually either one or the other. Some will let you have two. The problem is that unless you know the real FICO and all three scores, it's really hard to determine what is the middle score of those three. So again, we know the credit score for the purpose of the loan is a 589 because it's the middle of the three scores. I want to take you here. As you can see, it's a real credit report. We have the scores listed. Now, the first thing we do is, again, when you're dealing with a no overlay lender, like for instance, here at Simple Lending, we do have no overlay lenders for VA loans. So at 589, it's not what determines whether we can or cannot do the loan. This is not the same as when you a lot of the other lenders out there that they have the 640, the 620 FICO requirement. As I mentioned on a previous video, these are overlays. So a 589 is not what determines whether we can or can't do the loan per VA guidelines. It's really going to be the credit history. So here it's just, you can see there are plenty of good standing, good open accounts with good payment histories. This is just showing you. Again, I didn't want to just skip to the negative. I wanted to show that there is there's a reason when manually underwriting a loan that it's more than the score, and this is going to show us that we have a good credit history so far. So we know that particular customer has established credit that's in good standing. So it does give a lot to bite into. And just keep going. You can see that all these good standing accounts. There's no red, there's no alerts, there's no negative marks. Side note, if you notice this customer, there's something that's really interesting, and I know you've seen online. Some of you, I've actually had customers ask me about this. If you notice, there is this really neat feature that you can do with Experian. As you can see, it's the only source reporting it, and it says telecom self-reported. What this is, if you're trying to help boost your credit, if you're trying to help generate or show more in your credit to boost the score, Experian does offer you the ability to report regular utilities, such as in this case, you can see a cell phone, you can see the Comcast cable company, your internet. So you can claim these, you can report these things, and they actually show on your credit, even though it's by one bureau only. But as you know, and when it comes to your credit, it is going to be the middle of the three. So if this can help boost the FICO score through Experian, it does help boost the averages of the score. It's a really neat feature. Just check out Experian online, read all about it. I've seen a lot of customers using this, and it's an interesting tool. Also, whenever you are buying a home and you go into the mortgage process, as you can see here, it says telecom self-reported, and it shows balance of 177, payment 177. It's because what it's doing is actually reflecting the balance, the payment as the balance, and it also reflects the payment. Um, when you do this, when you're doing a mortgage, because they are utility accounts, the lender does not count those. At least they shouldn't. So the proper way to go about this is whenever these comes in, we loan officers omit this payment from the debt to income calculation, because in a loan they are not counting things such as light, water, utility, cell phone. So this help work on your credit, but not as an expense, because the loan officer does omit that. Actually, you know what? Let me also go back to something additional here. I don't know if you have student loans with VA, for instance. I want to show you how this looks for us. I have a lot of customers when we bring up about the student loans, we see the balance and then there's no payment. Right now, there is whether with COVID or whether you're still in school, where you have your student loans deferred. So this is what it looks like to us in the credit side. It just shows that you have a student loan, what your balance is, zero payment, and no notes. This is basically alerting us that you're under some sort of either deferment or income-based repayment plan. There is something there that there's no payment reported. The proper step to follow this is to follow up with you, the customer, and to ask you for the paperwork that it shows us what is the payment on that. Or we're also given, for instance, with VA, we're supposed to take the balance and we times that to 5%, and then whatever that gives us, we divide by 12, and that is the defaulted payment amount that we put here. That is if the student loans are either they are currently active or they're deferred to come due less than 12 months. With VA, if it's deferred for over 12 months from the closing date of the mortgage loan, we can just leave it at zero if it's deferred for over 12 months. In a lot of cases, when you try to get the deferred extended, they make you wait till the deferment period expires before you can extend it. So VA does have a very gracious default calculation for that by doing the current balance times 5% dividing by 12. But VA will also allow us to use the actual payment if you provide us with the documentation. But that is the proper way of handling student loans. Let me show you here. So we went over the student loans. We went over the telecom self-reported feature provided by Experian. All right, so we saw there was a lot of good. Here's where we get to the red. This is all the derogatory and collection accounts. So we know that the credit score are low because there are collections and derogatory on the credit. However, per VA guidelines, the real guidelines from VA stipulates that if you have if we're in a manually underwritten loan, which this is cost when we have a low FICO and the automated system just says it requires eyeballs to review and go through the checklist, that it meets all the criteria. One of the things VA stipulates is that the veteran must show reestablished credit for the most recent 12 months. So the way to translate that is that the veteran must have a clean payment history for the most recent 12 months. So if you come to me on August, we're going to look at your credit and we're going to make sure you haven't had any late from August 2021 to August 2020. Once it passes August, you have your 12-month reestablished credit, then we have satisfied VA's reestablished credit rule. So when we look at these accounts, for instance, right, we show there were some late payments and it seemed to have like a running tally. But however, the last time it was late was May 2020. So we're past 12 months from now because again, we have that window there. We have a late payment that was, it doesn't tell us when, it doesn't give us a last date, but it does tell us that this account was paid and it was an active, last active was 2014. So we know that whenever that late payment happened was prior to 2014, which tells us we have still a clean 12-month reestablished credit history per VA. Again, we continue to see open accounts last late 2014, over 12 months from now. We have a car loan that is in a collection. This has been charged off, which means the lender, that creditor gave up and wrote it off. So they are not pursuing the collection any further. Now, because again, last late was 2016, last active 2016. It was over 12 months ago, and you can see in the notes it says charged off. This is a charged off account. Um, Here it mentions account previously in dispute. A lot of these credit repair companies and a lot of this University of Google credit gurus, they always like to recommend to dispute everything. That is basically trying to catch a creditor off guard in hopes that, per the Credit Reporting Act, if you dispute it and the creditor has a small window of 30 days, and if they can furnish the data, they have to remove it. That is an attempt of trying your luck. However, when you dispute everything and you go for a mortgage, if the dispute hasn't been resolved and is still current, the lender cannot move forward until you actually remove or resolve the dispute. A lot of times your credit score is actually higher when the dispute is active, because sometimes the credit bureaus will block that trade line from affecting you while it's in dispute. Once you have to remove it, because that's the only way you can move forward to buy a house, then whatever affecting your credit that could have had will come into play. So I always tell the customers before the pre-qualification phase, that this is something they have to do, that we're running a risk that the credit score could potentially change, but there is no way to really move forward without it, because every underwriter has to have the customer remove that dispute. So it's better to just see what we really look like rather than go under contract, then take the gamble, and then have any scares or anything of the sort. So I just wanted to bring that up, since that account, it was a dispute that's resolved. So being resolved, it lets us not have to worry about it. And again, the dates was 2016, so it still gives us, we're still having a clean 12-month history. Now, there was more pages of it, but it's all going to be a repeat. Everything was clean. I don't want to drag this on to a full 16 page. So I wanted to show you this. This is a customer that, like I told you when we started, this customer was turned down, as you can see here in the inquiries, by several mortgage lenders that could not do the loan. But this is caused by overlays, misinformation, or just short lack of knowledge on how to do the loans or how to underwrite them. We were able to successfully do this loan, and this is a loan that, again, a lot of people question. If we were able to do this loan, is this a hard money loan? No, it's a VA loan. It's not a hard money loan. This loan perfectly fits within VA's guidelines. Again, most of the reason that a customer like this would have been denied, it would have been caused by that lender's overlays, not because VA can't do the loan. So whenever, when I encourage realtors, when I always bring up this second opinion service, it's really because the sad part is that this customer was actually pre-qualified. And after being pre-qualified, went under contract. And after being under contract in the underwriting process, the underwriter turned the deal down. So this is caused when the loan officer is not very knowledgeable on whether they can or can't do the loan. Then they preemptively, I guess, they just send out this pre-qualification, and then at the underwriter they were like, no, we can't do the loan, at least not here. The realtor then was obviously being pressed, trying to save the deal because they were already under contract, and continued following up with different lenders, and every lender just was not able to do it. We were obviously able to, because the realtor within his network of other realtors, they told him about me and that this is what we do. But this type of situation happens a lot when a customer will go and apply for a loan, and the lender, when they receive this, they immediately go into denial mode. They immediately go into just telling, denying the customer, telling the customer that this loan cannot be done, and that is not the case. Clearly, and again, I mean, if that is the biggest difference when you work with when you go to a bank, when you work with a mortgage lender, or when you go to a broker. The difference there is this, and I'm gonna give you this. When you go to a bank, the bank is always going to have the highest standards. They're always going to have the higher FICO requirement, and they're always going to have the more vanilla loan program. And it's only because the bank has so many different income revenues, with the checking and savings and personal loans, etc., that they're not really trying to put any of their assets or money at risk in the mortgages. So they're going to cherry pick A plus paper. When you go to a mortgage lender, some mortgage lenders, just the same thing. Consequently, they are going to create a nice little safety net for them, where they're going to cherry pick deals that are easy for them to do, that requires no risk or at least that after they originate the loan, it doesn't get insured and bought afterwards by FHA, VA, Fannie, and Freddie. So they don't want to do a loan that they don't really understand. Then you have more aggressive lenders that actually do. Most of these aggressive lenders actually are more dealing more through the wholesale channel for us brokers, where they actually want to concentrate more on the underwriting and let the loan officers be the one that carry the burden, if you will, on knowing whether the deal can be done or not. So when you deal with a broker and we have access to all of these lenders, we learn what every lender can and can't do. So when you go to, for instance, and I'm going to use an example because this happens a lot more for my customers in the Fort Stewart area in Georgia. They go to the veteran type lenders, right? So, I mean, they'll go to a Veterans United and they'll be denied because of something very similar to this because they don't do it. Now, they know that there's lenders that can. But what they do is they tell you that they can't do the loan and they put you on this little credit repair company program that they have. So they try to keep you in the system and they try to work with you until they can get you credit where it needs to be. Now, what a lot of things that happen with situations like this, and I'm going to show you because this is a perfect example to show you what I was referring to in my previous videos. I've had customers that when they come to me, they have exhausted any money that they would need to close on the loan because the lender has told them to, go ahead and pay the $104 balance on the Capital One. Go ahead and pay, try to see if you can settle that dispute. And again, there's more pages, but I wanted to keep it shorter than what this could have been. And what they do is they make them pay all these accounts, right? And the promise is that if you pay this, your credit will go up. But what they're trying to do is get you to qualify with them because they don't want to lose your business. However, what they're not understanding is that when you're in the community, when you're a local lender and you're part of this community, you're partly responsible for the success of a lot of these families living the American dream of becoming a homeowner. So just because if I can help you today, I'm going to tell you if I know someone that can. So I mean, and I wish that you would do the same for these customers, and this goes for the realtors too. If you're a realtor and you have a customer and you send it to your preferred lender or to your buddy lender and they can't do the loan, it's always good to try to get involved into the why, because especially for realtors, you're not real estate agents, you're people agents. You are the face of real estate. You are the face that connects the family with the home. And a lot of these customers, they actually entrust you to guide them to the right lender to do what's right for them. And if you know that there's a lender that is providing better service, better terms, better interest rate, or that can even get them approved when they're being denied, you should do right by your customer and at least guide him. Like this realtor did. This realtor had his customer and he knew that he was under contract and he knew that he wanted to get her into this home. And he did not stop trying to save this deal. And he even inquired until he heard of me and he was able to bring me the client where I was able to bring it home and I was able to close this for them. But it is very imperative that you understand just because you're being told no by a loan officer, whether it's at a bank or a mortgage lender, it is even if it was a broker, because at the end of the day, you know what? This program exists, but knowledge is power. And not every loan officer knows it the same way. Some loan officers want to specialize in certain kind of loans, and it's okay because you know what? At the end of the day, if that's their niche and if that's what they feel comfortable with, then that's how they're providing the best customer experience for you. I take pride in doing a paper all the way to similar cases like this, and I love being the underdog, and I love helping the underserved because this is a family that would not have been in a home today had they not come through me, and I want to specialize in this thing so I can get more people in a home today. So I understand that we're a small company and we're not everywhere. You probably haven't heard of us until today, but I want you to know that we are an option. We are a better option because right now, this client that would not have been in a home otherwise is in a home today. And believe it or not, we have been able to, there's so many other overlays, examples that I can't just put into one video, all the different examples and all the different scenarios, but I am glad to share this one that it could at least bring light to how we do what we do. And no, it's not hard money. It is a VA loan. This is a perfectly insurable VA loan. And we have done the same thing with FHA. And we have done the same thing with USDA. So this is what I wanted to bring into you to connect what we have talked to previously. So now I can illustrate it in a better way for you. Now, again, not every 589 FICO will qualify. We're not going to be able to get every customer, because again, remember what we talked about. It's in some of these instances, it's not about the FICO, it's about the credit history. Had this customer had late payments or collections in 2021, that would have been a different story. So that's what we look for. We're looking for a clean 12-month payment history. We're looking to make sure that we're within the debt to income ratio guidelines, and we're making sure that we're at least above the 500 credit score, which is where our lenders work with. If you have any questions, please, drop a comment, drop a message, email me. We're licensed in Florida, Georgia, and Alabama. Um, we just want to put the truth out there. It's all about honesty and transparency, and it's all about putting family into homes, because you know what? At the end of the day, it's the American dream, right? Georgia Simple Lending Mortgage. You have a good day.